Welcome to another edition of Taking Stock for the week ending Friday, the 30th of May, 2025. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our equities analyst, Jason Yin, to stream to you all things share market. Great to have you on the show, Jace. How are you?
Doing very well, Ken. 30th of May. Almost half a year gone, Ken. This year's gone extremely quickly.
I know, just one more month and the end of financial year's upon us, and
Mm.
we need to sort out our tax returns. The big year this year with the gains in the market, and perhaps you might be in for some unrealized gains with the government policies coming through. But before we jump into that, just a quick yet important reminder: the information we share today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures isn't a reliable indicator of future performance. Well, Jace, let's kick things off with the markets first. Now, sentiment this week, it turned rather positive after Trump unexpectedly postponed a proposed 50% tariff on European Union goods from the 1st of June to the 9th of July. And in a major development as well, a US federal court, they blocked these Liberation Day tariffs from taking effect, ruling that Trump overstepped his authority. Although this is positive, though, the ruling does add further uncertainty to the US trade policy, which has been the driver of market volatility in recent months.
Yeah, that's right, Ken. And speaking about volatility, I think last night the appeals court actually overturned the decision to block Trump. So
Mm,
it's one of those tit for tat things.
mm.
US politics and US regulation and policies is definitely something that's very weird and seems to go around quite a bit. But closer to home, Ken,
Mm.
Australian inflation came in a little bit hotter than expected. The April monthly underlying annual CPI figure came in at 2.8%, which was a minor rise from the 2.7 in the previous month. This has thrown a bit of cold water on expectations for near-term rate cuts and could keep interest rates a little bit higher for longer, and it could represent a potential headwind for technology, consumer, and property related stocks.
Yeah, that's very interesting, Jason. A company that potentially could be impacted by interest rate rises is Australia's largest telco and star income stock, Telstra. Now, the stock has been one of the quiet achievers of 2025. It's up around 43% year to date. Will this momentum continue, Jace?
Well, it's a very good question, Ken. Telstra has experienced positive earnings revisions on the back of mobile postpaid plan price increases,
Mm.
also cost reduction initiatives, and also technology investment into its AI partnership with Accenture. Operationally speaking, Telstra is investing $800 million over the next 4 years to maintain its mobile network leadership and also to launch satellite to handset messaging services, which could expand its rural coverage.
Yeah, it seems to be doing the right thing, Jace, and
Mm.
it's outlining its new connected Future 30 strategy that suggests that its business is aiming to be more profitable, and the additional debt, though, that could lift its return on equity over time. So, will this lead to an improved dividend profile, Jace?
Yeah, that's the question on many people's minds, Kian. The extra debt from our perspective should not impact its strong financial health rating. But from an income perspective, the company plans to return a further capital to shareholders. In fact, analysts are predicting or forecasting 2.7 billion worth of buybacks by 2030. And this could mean a reduction in its share count by around 6%, potentially leading to a rise in dividends per share in an absolute sense.
Yeah, that's a great point, Jace. And its forward gross dividend yield is currently just under 6%. And it looks sustainable. You've got the market projecting free cash flow to rise significantly this year. And although the payout ratio does appear high, though, the free cash flow margin above that dividend payment provides sufficient buffer for dividend estimates moving forward, Jace.
Yeah, the only issue for income investors, Ken, is perhaps the uncertainty around its future franking credits. At the end of first half 25, Telstra reported 275 million deficit in its franking credit balance. Despite this, management has expressed confidence in providing a fully franked final dividend to shareholders.
Yeah, something that income investors will have to look out for. But moving forward now towards electricity distributor and borderline star growth stock, IPG Group, its shares fell by about 8% after the company released their financial year trading update. What happened here?
Well, management expects revenue to grow modestly, but forecasts a decline in underlying earnings due to a shift in more competitive, larger contracts. There's also been challenges in the commercial construction space, and also project delays are weighing in on some of that performance that we've seen earlier.
Yeah, definitely some headwinds there, Jace. And it does appear that this update is a marked step down from IPG's financial year 24 results. And of course, it potentially could lead to further downward earnings revisions, although the number of covering analysts on the stock is relatively low at around four. So, what is our view here on the stock, though?
Well, we think this is going to be a transition year for IPG. I mean, from a structural growth areas like data centers, which grew around 25% and now accounts for around 10% of group revenue, these sectors have been helping to offset some of the short-term headwinds that you've mentioned a little bit earlier, Kien. So we still view IPG as a pretty solid business that's capable of potentially recovering some of those margins in FY26.
And turning our attention now to respiratory care business and star growth stock, Fisher and Paykel Healthcare. The company did hand down their financial year 25 result this week. And while the numbers for the year were solid, what caught the market's attention was the softer than expected financial year 26 guidance. And management is forecasting about 10% revenue growth. And that's around 4% below market expectations, largely due to easing post-COVID demand in home care, a more cautious pricing environment, and currency headwinds from the stronger New Zealand dollar.
That's right, Ken. But however, there were some pretty impressive takeaways. For example, revenue over FY25 rose 16% to just over 2 billion New Zealand dollars, which was at the top end of management's prior guidance. And also net profit jumped 43% to 525 million New Zealand dollars as well. And that's been a pretty strong result, particularly given some of the ongoing cost pressures across the sector.
Yeah, absolutely, Jason. What stood out to me was the continued strength in that hospital segment. Consumables, they were still up around 20%, and
Hmm.
hardware also saw solid growth as well, reflecting the rebound in global hospital activity. It's a reminder that while the pandemic provided a temporary boost, the long-term growth story here is still intact. You've got rising demand for respiratory care and surgical humidification solutions, and that's driven by aging populations and increasing healthcare investment.
Yeah, and based on those factors that you've mentioned, Kim, we have retained the company as a star growth stock. We believe that they'll continue to meet our key growth and also financial health criteria. And even with some of those near-term cautions baked into that guidance, it still looks rather positive.
Yeah, one to watch closely, Jason,
Hmm.
specifically around those US tariffs and the uncertainty still lingering there. But we think this still earns a place in your portfolio. In Under the Microscope this week, we take a closer look at star growth stock, Wisetech. Now, the logistics software giant, it announced the largest acquisition yet, snapping up US-based E2 Open for around 2.1 US billion dollars. So, Jace, let's start with the big picture here. What's the rationale behind this acquisition?
Well, Ken, it's all about strategic expansion here. E2 Open is a major SaaS player in the global logistics space, and they have over 500 connected businesses on its platform. The deal would allow WiseTech to significantly broaden its offering and would move it from a pure freight forwarding focus to a much larger ecosystem, which covers trade compliance, supply chain planning, and also channel management as well. So, from our perspective, it's a pretty strong strategic fit that aligns with their vision to become a global operating system for logistics.
Yeah, it sounds rather positive, Jace, but I'm mindful of these large acquisitions, especially
Hmm.
when they're funded by debt. It looks like it's been fully debt funded via a 3 billion US dollar syndicated facility, Jace, which will lift its debt to 3.5 times its EBITDA, which is really underlying earnings multiple. That's higher than usual, but management has been clear. They are targeting a reduction of that debt level to below two times within 3 years. But investors seem to believe this, and the share price reacted quite positively.
Yeah, the high levels of debt that the company is taking on is a little bit worrying. However, there were a few things that were positive from management's comment. And more importantly, I feel like management's retention of FY25 guidance is actually a positive thing. And also aside from the 40 million in one-off costs that they did mention. But having said that, the price also looks pretty reasonable, Kian. I mean, they're paying just under 10 times EV to earnings, which is based on E2 Open's FY25 numbers. And from this perspective, the ratio of payments is rather attractive for a business with around 87% in recurring revenue and also positive cash flow as well. The third reason is management hopes to realize at least 50 million US dollars worth of cost synergies by the second year. And this could come from stripping out duplicate functions, public company costs, and also improving overall operating efficiency of the group.
Yeah, well, they do have a track record of acquisitions and successfully implementing them. But how does this shift the earnings outlook and the rising debt levels? How would that impact the financial health of the business?
Yeah, it's a pretty good question, Kien. Look, the acquisition is expected to be earnings accretive from year one, but the full year benefit won't really flow through until FY26. So that's why the FY25 figures will largely be unaffected, with the exception of potentially some of those deal related costs that I mentioned earlier.
Yeah, there seems to be a delayed impact here, but we'll get more detailed guidance at the August full year result. But of course, this deal doesn't come without the risks. You've got integration challenges, and this is a large cross-border deal, and you've got E2 Open. They operate across 20 countries as well. You've also got that cultural and operational fit, which is something we'll be watching very closely.
Yeah, that's right, Ken. All things considered, it's a big swing for the fence, Ken, but a pretty rather calculated one from our perspective, which is why we've retained the stock as a star growth stock, and this has given some of the strategic benefits, the solid fundamentals, and also the long-term earnings potential.
With so many company updates occurring over the last month, a question that is often asked among our members is, how do investors know when to sell a stock from their portfolio?
Well, this is a very good question, Keen. One of the first things to look at is how the update affects the company's financial health. If the company is taking on more debt or its profits are falling, then that could be a bit of a warning sign. For example, a big drop in earnings or a downgrade in profit forecast might cause the company to no longer meet its key financial metrics. And another thing to watch out for, if a company announces a major acquisition that doesn't boost earnings anytime soon, this could be a bit of a dilutionary impact to shareholder wealth. We actually stopped recommending James Hardie after it acquired Aztec for this very reason. So if we remove a stock from our star stock list, it's worth reassessing if you still want to hold it.
Yeah, definitely, Jason. And if a company releases a profit downgrade, we also need to understand the reason behind it. Is it just a short-term problem or something more serious for the longer term? Company leaders, they're usually very hopeful. So the first downgrade may not be the last. So you've got to look at how strong the business is overall and whether it can bounce back over time. And a good example of this is IDP Education. It's going through a rough patch right now, but we believe in its long-term future.
That's right. And you can also track earnings trends in Stock Doctor by setting up alerts. If earnings are going down and you're not sure why, then have a read of our strategic comment or speak to one of our analysts. And for investors who follow price trends or technical indicators, it's also important to act if those indicators are triggered. For example, if a stock drops below the SD30 TSR line, even if it remains a star stock, then that's a sign that you should start selling.
Yeah, definitely, Jason. And it's not just about selling those bad stocks. If a stock goes up too much, too quickly, though, it's also smart to sell a little and lock in some of those profits. That way, you're not putting all your eggs in one basket.
That's right, Ken. Selling can feel rather emotional, especially if you've held the stock for years, but it's important to stay disciplined. Remember to stick to your investment strategy, whether it's based on company fundamentals or technical indicators. Most of all, you need to manage your risk. Make sure that your portfolio is well diversified by at least 15 stocks, and also stay focused on high quality businesses that can deliver strong long-term results.
Yeah, and for those members who want to read more about this, they can refer to our white papers under the Resources Centre. Well, that's all we have time for today. Jace, thanks for your contributions.
Thanks so much for having me.
And again, as Jace pointed out, investing can be an emotional roller coaster ride, hence the importance of blocking out all that noise and focusing on what you can control, and that's the management of your portfolio. Thanks for watching. Take care and have a happy, healthy, and prosperous week ahead.